Hello and welcome to marketing91.com. Let's start with introduction to budget. The government budget shows the planned expenditure programs and expected revenues from taxes and other sources during a given year. The government's functions in the economy are guided by the budget policy. The important functions of budget policy are: allocation function. Budget policy is concerned with the provision of social goods. Distribution function. Budget policy ensures a fair or just state of distribution of income and wealth in the economy. Stabilization function. Budget policy is concerned with maintaining high employment, reasonable degree of price stability, soundness of balance of payments, and appropriate rate of economic growth. The budget contains a list of specific programs like education, defense, welfare, etc. that need government spending, as well as tax sources like income tax, commodity tax, etc. that earn the government revenues. Budget surplus. When all taxes and other revenues exceed government expenditures for a given year. Budget deficit. When government expenditures exceed taxes and other revenues. Balanced budget. When revenues and expenditures are equal during a given year. It is a rare phenomenon. Let's understand this through a graph. Government expenditure is assumed constant and revenue is assumed to increase with national income. Point E denotes a balanced budget. Area left to the point of E denotes budget deficit, whereas area right to the point E denotes budget surplus. When the government incurs a budget deficit, it is financed by borrowing. The government borrows from the publicly issued government bonds, thus creating government or public debt. Types of budget are balanced and unbalanced budget. In a balanced budget, revenues and expenditures are equal. Neither a budget deficit nor a budget surplus occurs. In an unbalanced budget, revenues and expenditures are not equal. When revenues exceed expenditures, we have a surplus budget, and when expenditures exceeds revenues, we have a deficit budget. In a traditional budget, an incremental approach is used. Program and projects from previous years are automatically continued and funded. In a zero-based budget, the budget starts from a zero base and every government function or item is analyzed for its needs and costs. Existing programmers and activities are not automatically funded. Instead, their continuation as a part of the annual budget process must be justified. Performance and program budget. A performance budget considers the result or performance of a program and thus ensures cost-efficient planning. It relies on three aspects: understanding the final outcome, strategies formulated to reach these outcomes, and specific activities to be conducted to achieve these outcomes. The process is very detailed and result-oriented in its approach, and it is mostly used by organizations and ministries involved in developmental activities. In a programmed budget, major government functions are divided into specific programs, activities, and projects. Emphasis is laid on the programmer's size, implementation, costs involved, and expected benefits. Funds are then allocated accordingly. Multiple budget. In the US, the government budget was divided such that each part highlights the specialized functions of the government. Thus, a unified budget was needed for understanding the overall effect on the economy. A unified budget includes receipts from all sources and for all programs of the federal government, including both on and off-budget programs. It is a single measure of a government's fiscal status based on the sum of all government activities. When these fund groups are consolidated to display budget totals, inter-fund transactions are deducted to avoid double counting. Functional and cash budget. A functional budget includes incomes and expenditures that are applicable for a function or department. It is an accrual-based budget and it mentions the revenues and expenditures for government functions on an accrual basis. It excludes receipts and expenditures that do not belong to the government. A cash budget is a detailed plan that shows all expected sources and uses of cash. It includes the following: beginning cash balance. It is the last period's closing cash balance. Cash collections. It includes all accepted cash receipts for the period considered. Cash disbursements. It includes all planned cost outflows for the period considered. Cash excess or deficiency. It is a function of cash needs and cash available. If cash available is less than cash needs, a deficiency exists. Financing. Reflects planned borrowings and repayments. Legislative and executive budget. A legislative budget is prepared by a legislature directly or by committees. A legislature consists of elected representatives of the government who have the power to enact, amend, and repeal laws. An executive budget is prepared by the government's executive wing. The executive is responsible for implementing the budget proposals prepared by the legislation and executives. A revenue budget covers items that are recurring in nature and shows both revenue receipts and revenue expenditures. Revenue receipts consist of tax and non-tax revenues. Non-tax revenues consist of interest and dividend on the government's investments, fees, and other receipts for services rendered. Revenue expenditure is spent on maintaining existing levels of public service and is divided into plan and non-plan expenditures. Plan expenditure includes spends on social and community services such as education, health, agriculture, industry, power, transportation, and communication. Non-plan expenditure includes spends on administration, that is, wages and salary payment to government employees, defense, interest payment on public debt, grants to state territories, pensions, subsidies, and grants to foreign governments. A capital budget covers items related to acquiring and disposing capital assets. It includes capital receipts and capital expenditures. Capital receipts include funds received by the government such as market borrowings, small savings, provident funds, loan recovery, external loans and disinvestment or any other receipts from sale of government assets. Capital expenditure includes debt repayment and all spends on creation of capital assets like roads, railroads, irrigation and power generation projects as well as establishment of schools, healthcare, infrastructure, etc. Thank you.